Yeah, so just a normal reminder. We're recording these training sessions and they do actually go on YouTube afterwards so different people can see them. So anything that you ask can be recorded and used in evidence against you, as we say. Yeah, no, so feel free to ask questions, maybe make comments, but yeah, be aware that yeah, that will be for the benefit of future people listening to these sessions. So we're going to get started straight away on to joint ventures. Obviously, we're speaking about property joint ventures, but in practice, the same things can apply to any business joint venture. Yeah, people can be yeah, agreeing to do something together in business, and the same things apply. It's true that in property, when we're talking about joint ventures, typically there's a sort of balanced relationship where there's quite often one person who is finding the deed and looking after the main things that has got like the a big experience in property. And then there are other people coming onto the deal, typically bringing some of the money into the deal. And there can be two objectives. One objective is quite simply to get a good return on the money. And then the other objective of people coming into a deal, in inverted commas, as like passive partners, it's also to get experience. So to understand how things are done, if it's like, for example, a conversion or construction project, understand yeah all the different things that happen, planning, project management, finance, and all that sort of stuff. So we'll get on to the next slide. So we're going to be looking at yeah, benefits of joint ventures in property investment. We will be looking at some of the downsides as well, some of the things to bear in mind. And we're going to be looking at some real examples we'll be looking at some joint ventures that I have underway or that we're likely to be starting, not specifically with the objective of me promoting these joint ventures, but obviously because I know them, I can use them as examples. And the idea as well is not to present everything as ideal and nothing can go wrong, but to yeah look at the different potential issues on these type of projects. So, what are property joint ventures? So, typically, we're talking about a collaborative like venture between an experienced property operator developer and it's written here an investor, but it can be one or several investors who are looking to get a good return on their money, but with limited involvement. So typically in property, it can be like people that either they might have already done their own property ventures. They might have like bought buy-to-let properties and be operating them, but they understand that, yeah, potentially can get a higher return by doing bigger things like, I don't know, building block of residential or converting offices into flats, that sort of thing. And they want to, yeah, get profit from that return, but without actually doing all the work. So in that case, yeah, joint venture is uh, ideal way of getting into something like that. But in practice, as written here, it can be any project.
Trevor,
Trevor, I think we've lost your sound.
we lost you lost you there.
Really?
Yeah, just for about 5 seconds, I think.
Oh, it just says my internet is unstable, which is strange. Yeah. Can you all hear me now?
Yeah.
Yeah.
Okay. Yeah. Thanks for mentioning that. Yes, I'll just come back on. Yeah. So typically, joint venture, there's going to be one person, or it could be like a group of people that have done things together that are the experienced operators and developers that are basically running the show, and then investors coming on board to get the return, yeah, typically a higher return on money than if they were yeah, doing it in like some of their own smaller projects. But in practice, so as it's written here, it can be any project where two or more people are involved in a project. And this is actually quite important. It's got varying financial knowledge slash experience and time contributions. And a key thing when we're going into a joint venture is if someone's bringing specifically money into it, someone's bringing expertise and previous things they've done, knowledge about how to structure deals, how to set up the joint ventures. And maybe someone's actually coming in with what I call a time contribution. It could actually be a project where there's building and this person is a tradesman and this person is going to spend a few weeks doing some real work on the project. Or it could be someone that's got, let's say we're doing a project for there's going to be serviced accommodation. So someone who's got some experience in that, but specifically is going to contribute time to yeah, managing the property, looking after guests and all that sort of stuff. So each person coming into it, and it can also be each person might one person might be bringing some level of finance, some level of experience and knowledge, and some amount of time. Some person might be bringing only finance, and one person might be bringing only knowledge and experience into the deal, or another person bringing only their time or contribution of maybe tradesman or other skills. And in reality, we're not specifically putting a monetary value because that gets quite complicated. Let's say, for example, one person is bringing £100,000 into a project. Another person is, yeah, setting everything up, um, finding the property. We can't say that that is specifically worth, for example, £80,000 or a specific monetary amount.
Mm.
But it's important that when, let's say, keep it simple and say it's two people, one person is bringing money, the other person is bringing the experience, potentially also sorting out the finance, backing the finance. And it's important that those two people agree that for what each person is bringing, each person is comfortable. For example, that it's a 50% share of like the ownership and the ongoing income for what each person is bringing. Because what is, yeah, let's say really bad is if, for example, the person bringing the experience really believes that that is worth, let's say, 50% of the share of the project. But the person bringing the money in is thinking, well, I'm bringing the money. True, the person has the experience, but it's not worth 50%. It's sort of only worth like, let's say 25%. And if it starts like that, then people in the deal are not comfortable and there's going to be problems down the line. So it's, yeah, it's like really important at the beginning, and especially when there's more than two people coming on board, is people to be comfortable of, yeah, for what each person is bringing, what share of the deal are they going to have? Because the person who's bringing the money but doesn't have the experience, that person is not going to get yeah, let's say this good return on investment without the person that has the experience and the knowledge and potentially the time. So there has to be a real understanding of what each person is bringing and that people are comfortable with it. Yeah, so we can have varying degrees of what each person is bringing, but in, yeah, the most common scenario, one person with the experience and one or more people and bringing in the finance. So why joint ventures? So yeah,
Perfect. That's the question. Sorry.
yep.
So, what are your suggestions then, to mitigate on that risk that you've just mentioned there? Would that be just looking at getting things in writing from the get-go. Well, what is the
Well, it's not so much getting things in writing because whatever the situation, things have to be put in writing anyway, sort of thing. It's more like having an open discussion at the beginning. Like, let's say we take a stand, I've got a standard scenario, but obviously there can be variations on a theme. A standard scenario in a joint venture is that I'm finding the deal. I'm bringing my experience and my time to sort out the finance, sort out the planning, sort out who's going to be doing the work, who's going to be doing the project management, and basically ensure that the project is successful. And in quite a few cases, I'm putting my personal guarantee against the main bank finance that we're doing. And then the other partner is bringing in primarily the deposit money and the money to cover like legals and like getting started. And typically on this type of basis, I'm thinking that 50-50 is a good split. So I'll be saying to the person who's coming in with the money, let's say, for example, we need £200,000 for to get into a specific deal. I'm going to say to the person, look, you're bringing the money, I'm bringing all the expertise, I'm backing the lending, etc. 50-50 seems a good share. And then that person, but without like forcing them, without saying this is how it must be. And then the
Mm,
other person is saying, yeah, that makes sense. And also at the same time, it's needed to calculate and on the financials that for that specific amount of money that the financial partner is bringing in, how much of that money, for example, is that partner going to get back when we've finished for example, the construction, and maybe we're going to refinance. And for the money that the investor is going to be leaving in the deal, what is the return on investment? Obviously, it's not going to be guaranteed, but what is the anticipated return on investment? So if the person sees, for example, that after the refinance and on the money left in, that he or she is expecting to get like 20% return on that money left in, it seems, yeah, it's like a good return. And that 50-50 share of ownership is fair. But it's really a question of like appreciation and what people are comfortable with. There'll be some people who are like people like financial investors, even though the return is there, they won't be able to get sort of their head around the fact that it's 50-50 share, but one person didn't put any money in there, but put time and experience.
mm,
And another person
Trevor,
will
can
come
I?
into it thinking, this is a great deal because this person really has experience and the project is got all the possibilities of being successful.
mm.
Trevor, can I just ask a question or clarify something actually? Um, so we're talking about joint ventures and joint venture partners here, but for example, I'm doing an earn and learn with someone where I'm putting money in and I'm getting a fixed return, and that's no matter what, right? So it doesn't really rely on the success of the project, right? At least technically, right?
Yes.
And I've discussed that with the person I'm doing the earn and learn with. So they have a mitigating factor. So if they can't get all the money back from their refinance exit, etc., right, they're still committing to delivering the money in some other shape or form by liquidizing another asset, right? Fine.
Yes. Yeah.
But that I don't consider that a joint venture, right? I've got no say in the structure.
No, it's not a joint venture
Yeah,
as such.
yeah, yeah.
It's
So that's an
basically
example where
an
I'm putting
investor
in,
loan that
yeah,
is backed up by some sort of guarantee.
yeah, yeah, yeah.
I know, for example, here we've got Monty who's on the call. He, on one of our projects did an yeah basically a investor loan. It's backed up by a personal guarantee,
Hi
and
guys.
yeah, hi Monty. Whatever happens on this project, he's going to get his money back, sort of thing. So it's not that's not a joint venture. It's I mean he has access to understand, yeah, some understanding and like what you say as the earn and learn. but it's not like it's not like a shared risk.
Hmm.
Yeah.
Okay.
Yeah, and generally the returns on that type of investment are going to be less than in a joint venture because when there's less risk, because someone basically, in the case there, it's a person, in this case, it's actually myself, who puts the personal guarantee on this investor loan. I'm
Mhm.
basically bearing all the risk.
Right.
Mm.
Yeah, so that that we don't call a joint venture. It's basically a it's a property investment, but it's a developer backed loan. Okay, let me continue with the with the training and the slides. Yeah, so why joint ventures? So it's leveraging expertise from other people. Yeah, generally reducing individual risk by sharing responsibilities. And also in a joint venture, typically the different partners are going to be asking questions and possibly, yeah, asking questions that someone who just rushes into a project by themselves because they might have got like the feeling that everything's going to be fine. They might not be asking all the questions, but when it's a joint venture, A, it's necessary to prepare all the figures, prepare the different exit strategies, prepare information about what we're going to do if something goes wrong. So yeah, it is in that way, it's reducing risk. And then the other thing, joint ventures, it's good for larger or more complex projects. And also simply from the fact that the larger projects need more capital, more deposit money. And joint ventures are an ideal way of getting these type of projects over the line. So key features of joint ventures. So typically we've got a shared ownership of a property. So all the parties says both, but it can be several partners own a portion of the property and receive a share of the profits. Generally, the finance investors, it's hands off for them, or they can basically come in and have as much feedback and involvement in understanding what happens. Generally, in a joint venture, there are some things like key important decisions that the partners are making together, but outside those, it's the principal partner that's managing all the day-to-day operations. An example of a decision that might be made is if, for example, we're going to decide on the end use as being service accommodation or an HMO, the different partners will come and decide that together. And then, yeah, typically joint venture projects are on, larger projects than your standard mid-terraced house by BRR type project. And yeah, there can be flexible goals on joint venture projects. So we can either be looking at refinancing, getting some of the money out and having the ongoing income, or straightforward develop something, sell it, and share of the profits. So here we're coming back to the roles in a joint venture. And as I indicated near the beginning, we can have like varying degrees between these roles. And it's possible that, there might be principal partner, might be someone that is bringing some expertise into a project, and then people that are only bringing in the money. So typically, principal partner is sourcing, so finding and negotiating the property deal with the seller, managing renovations, development, and all the operations. It's not written here, but he's also organizing and finding the main finance because still most joint venture projects are still done using bank finance, with the main reason being that leverage, and it enables to get overall higher returns than if we were only using investor money. And typically the principal partner will be providing personal guarantee on the loans, and yeah, ensuring that the project is successful. And then we have the investor partners in a joint venture, so providing the funding to get the projects underway, having a share of the ownership, the profits, income. They're taking like generally a passive role, so relying on the principal partner's expertise, but at the same time, they're gaining knowledge and experience from the principal partner. Obviously, here I'm saying quite a lot about um, investors and investors coming into joint venture projects. Obviously, for people that have got experience in property, then joint ventures can be used with the experienced person being the principal partner, setting up the project and opening it up to investor partners. So we've got why choose a joint venture? We've got on one side for investors and one side for the principal partners. So for principal partners, so for people doing property development, the obviously a key advantage is it's bringing funding in from investors to be able to do bigger projects or to be able to do several projects at the same time. And then yeah, there's the element of shared risk and responsibility. In a joint venture project, there is a high level of accountability. Um, Whenever the all not a question of all every individual little decision needs to be made by a joint committee of joint venture partners, but everything that's taking place, there's nothing like that's hidden. Everything is on the table. And then yeah, the profit sharing incentives for all parties. And then for investors coming into a joint venture partnership, is giving access to higher value projects with limited personal involvement. Is getting involved in projects where there's an experienced development or property expert basically in control of everything. So that's reducing risk. And typically, joint venture projects are giving a higher return to investors than independent investments. So, what are the risks and downsides of joint venture projects? The most important thing is not so much a risk, it's more like a downside and a question of like personal preference and what someone is comfortable with. When people are going into a joint venture, it it does need a high level of trust. People need to be comfortable about working with other people and understanding that, yeah, it's trust is needed and there are decisions that are going to be made together. And sometimes it's, yeah, needed to compromise on making decisions because obviously if there's two or three people involved and people have got a different opinion about how to do something, it's needed to, yeah, come to a joint agreement, which means each time there may be some level of compromise that is needed. So some people are like adapted and really comfortable about going into joint ventures, and other people are, yeah, let's say, uncomfortable about it. And what I consider really important is if, for example, you're looking for joint venture partners on whatever side it is, whether it be property developers or on the investor side, there's absolutely no point in trying to convince someone to come into a joint venture if they're not comfortable about it, because it's only going to have problems later on. So someone like coming into maybe training that I'm doing or coming into some of the mentorships that we do, we'll like try and identify that And someone that really isn't at all comfortable in doing joint ventures, we're going to say, okay, stick to the standard portfolio building, use the BRR strategy, um, maybe go into some group where you can observe what's happening on some bigger projects, but like do your own thing, but profit from like the network and what different people can bring into a group, but don't get into a joint venture if you're not comfortable in doing things with other people. Because it's true in a joint venture, we've got all the legal agreements. We're going to try and set out everything that can potentially happen and how we're going to deal with it. But at the end of the day, it's all a question of trusting other people and working together. And one other potential downside, we have to put everything on the table, is that this is like when people were saying, yeah, is a developer loan that's backed by a personal guarantee a joint venture? In reality, my answer is no, because generally in a joint venture, the investor funds, they're secured by equity. What that means is an investor is going into a project, they're putting money into there, and they're receiving shares, effectively shares in the company that's set up to do the joint venture. So the investor is receiving shares. Those are obviously shares that are legally and properly registered at Companies House, which give a legal share of ownership of the property. But if something goes wrong, it's first of all the bank that gets their money back. For example, if something goes wrong and it's needed to for the property to be taken and sold on auction, for example, and it that's going to raise generally more than enough to repay the first charge security, so the bank loan. And then if there isn't enough left to return money to the equity investors, then there's some money that's going to be lost. So that is where the risk is. Generally, what we do, not to remove that risk, but if, for example, I'm going into a project with a financial investor. So let's say I'm bringing my expertise, but I'm not putting any money in there. Potentially, I may be doing the guarantee on the bank loan. Then what we have in the, although in the shareholders agreements, let's say we each have 50% of ownership of the property and the project. In the case of something going wrong, it's written into the shareholders agreement that before, for example, I can take any money out of the deal, the investor who put physical money into it must get their initial money back first. So there are ways to like guarantee that and set priorities, and we look at that. And if you're investing in a project, it's important to understand and make sure that all that has been taken into account. But at the end of the day, there is risk in the same way that if someone buys shares in a company, there's a risk if that company fails, then the assets are sold, assets are distributed to the shareholders, but that might not be enough to pay the initial money. Downsides on the property developer side is its downside can also be an advantage, is the developer needs to be ready to share everything about the project, both the nice things and the not so nice things. Needed to provide regular updates, and generally it's needed to provide asset-backed guarantees for the main lending, because generally we're not asking an investment partner to come in there and take equity in the project and also give a guarantee. It's generally the property developers that are sorting out the guarantees. Then, obviously, we're not going to cover all of this in 5 minutes on this slide, but obviously, we've got a legal framework and structures and everything that needs to be set up for property joint ventures. And this is approximately the order, in fact, in which we do things. We start off with what's called a head of terms or heads of terms for the joint venture. This typically is we're writing on a piece of paper, probably it's two or three sheets of paper. We'll be covering the main points of the agreement. So what each person is bringing, how the profit is going to be shared, and in a few lines, what the end use of the property is going to be, and what happens if we sell it, and how are we distributing the profit? Are we going to be keeping some profit? And are we going to be refinancing and stuff like that? Then there's always going to be a specific limited company that we create to be able to buy and operate the property. That's the object of the joint venture. So we call it an SPV limited company. There's nothing special about this company. It's not like called SPV on Companies House. It's just a term that we use, meaning special purpose vehicle, which basically means we're creating the company with one specific purpose, which is to jointly purchase a property and get benefit from it and share the benefit to the different partners. Then we're going to have different share types. So the people that bring in the expertise are going to have different share types to the people that bring in the money, because that enables us to set out the priorities on who gets back the different things and in which order. Generally, for the people that are bringing in the money, it's one share type and the same for all of those people. Sometimes there might be two classes of share, because sometimes in the bigger projects, and if we're going to be buying something and we've got a risk on getting the planning, we might have a joint venture partner that comes in at the very beginning of the project. So obviously there the risk is higher, because if we don't get the planning or we have to go on to appeal and stuff like that, it can take longer. We can end up in reality potentially not getting the planning. So the initial partner won't get all the money back. So when that's the case, people that come at the beginning obviously are getting a higher reward than people that come in, let's say, at the end when all the planning is sorted out and we're basically ready to go. We've dealt with all the risks and we're just ready to go and we need the money to get the project over the line. So that can be another reason for having different share types. Then we're basically translating our three-page heads of terms into a probably 20 to 30-page shareholders agreement, which is the legal agreement that defines everything that happens between the shareholders, etc. And then at the end, people put the money in, the shares are issued, and everything is registered at Companies House. And that people that are in the joint venture, they can see their names. Or incidentally, most people who come into a joint venture come into it through a limited company. So if someone's bringing, for example, £100,000 into a joint venture deal, they'll create their own holding company first, put their money, their personal money into their holding company, and then their holding company will invest in the SPV joint venture company. Main reason is for tax efficiency, and also when an investor's money, like the share of profits coming out of the joint venture, goes into their company, they can decide whether they leave those profits in their company to reinvest elsewhere, or at what point in time they want to take that, basically crystallize those profits as personal income, depending on their individual personal tax situation. So I think that's enough about the legal structures. Obviously, it's several days' work to set up for each joint venture, and obviously legal fees involved in that. The best ways of limiting the legal fees is to have everything prepared and understood and already agreed before going to the solicitors. Because the solicitors will like to ask lots of questions and get people talking back and forth. But that then is going to be, yeah, increasing significantly the bills. So we're always, or I'm always working out everything, getting everyone agreement on everything, and only at the very end are we seeing the solicitors to make sure that what we've done is fine. And on joint ventures, we same as any project, but even more so in a joint venture, we need to define what are the possible exits to the project. So are we going to refinance and hold? If we're going to be holding, what type of end use, standard buy to let, if we're doing flats, serviced accommodation, HMO, possibly we're going to do something like serviced accommodation units or a hotel. Or are we going to sell everything? Or sometimes we might do a conversion and we might sell part in order to get our money out and then hold part for ongoing income. So we need to look at the different exit possibilities. And also on the right here, we need to look at the exits for the joint venture partners, because doesn't mean to say that people will want to stay in there forever. So we're going to talk about buybacks from other shareholders after maybe a few years. Typically, we're talking about 5 years. If someone wants to get out, the company can refinance and the company can buy back an individual shareholder's share. And then that obviously means a greater proportion for the remaining shareholders. Possibility of selling shares to outside people, and provision for resolution of conflicts and the specific um, provisions when it's only two people. Because when it's three people, then we can do things by majority decision. If it's two people with an equal share, we need to have specific, and there are specific ways of dealing with that. So just before we go on to some fast examples, are there any questions on what we've covered so far?
Yes, Trevor, I have a question.
Yep.
What happens if something happens to you? You're the leading light on the project, and something happens to you. What kind of mechanisms have you got to keep things going?
So there's two things. Obviously, the actual, and yeah, especially let's say in my case or in the case of the principal partner, there's the legal disposition of, obviously my ownership would go to people who inherit from me. However, in the shareholders' agreements, we give the right to the remaining original shareholders to appoint new director and to yeah, basically appoint, if necessary, an external party to deal with the project. For example, it could be that I was looking after. I'm not generally doing detailed project management myself, but getting someone else to do it. So typically, if something went wrong, it likely wouldn't immediately hold up like some conversion or building work, because there's going to be a project manager on there anyway. But yeah, there's dispositions that give the shareholders the possibility of, yeah, taking control of stuff immediately. And yeah, it doesn't
Okay, thank
require
you.
people that inherit from me to yeah, basically agree to what happens afterwards. So yeah, stuff can go on straight away. And yeah, we're always specifically looking, we have to consider, yeah, death and incapacity of every shareholder. And it's obviously simpler for the shareholders that are only financial shareholders.
Okay,
Any other questions?
I have another one.
Yep. Okay, Keith.
Um, if you've got a JV investor who's financing or bringing most of the finance to the project, would they normally do it in drawdowns? Would you want them to have the funds available to you from the start of the project? How do you structure that part of it, the funds and the drawdown part of it?
Yeah. Generally, on the joint ventures, because we're using development finance, so bank finance to fund the developments, basically from the building work, the bank finance is drawn down, but the investor finance is typically in one go because that is the deposit money to be able to buy the property and typically pay the first tranche of development before the bridging finance starts releasing the money. There are sometimes exceptions to that, and I've only got a few minutes, so sorry, I'll be running past some examples. One example, in fact, it's a project that I shared with you, Keith, um, that we're still going through planning on it. So we haven't raised the finance on it yet. But on this project, uh, we've got the possibility for the joint venture partner to fund all the development
Yeah.
of the project. And this is the exception. And in this case, it will be done by, yeah, released by tranche.
Okay.
Yeah. And especially this one, because this sometimes we've got projects that are open to SAS investment from SAS pension funds. And that actually would be a requirement of maintaining compliance with the SAS lending, because there has to be enough development work to cover a security that we might need to give to the lender. And so if we take all the money in one go, then that hasn't been translated into increased value of the property. Therefore, it doesn't meet the requirements of giving adequate security to the investor partners.
Okay. Thank you.
But in most cases, people are putting all their money in one go. So typically what happens, people put the money in, they get their share certificates, so the shares are registered at company's house. And then, yeah, the project just gets on and we're using bank lending for doing the development. Any other questions?
I have another one.
Yep.
Um, do you incorporate um, the loan document within the land registry CH1? How do you structure all the paperwork with all the contracts, and you said the shareholders agreements? Is it separate docs registered with land registry? One doc? How would you structure the whole
Right. So
documentation?
generally, um, loan documents, because generally it's not a loan document, except in the case, for example, of SAS lending. And there, that loan document would be the CH, whatever it is,
Yeah,
if it's required, sort of thing. As regards the general shareholding, you may remember I mentioned we've got different share types. So what will happen is, so let's say there's Class A, Class B, Class C, and Class D shares. There's going to be a two-line summary for each share type, and that's going to be visible on Company's House. So
right.
it might say share A entitled to 20 yeah percentage of income, and it might say preference on the proceeds of a sale before Class B, for example. If Class B, for example, was maybe my shares where I didn't put money in but put the expertise in.
Yeah,
So there'll be basically a two-liner on Company's House for each type of share. And then when there's the confirmation statement, normally we do an updated confirmation statement to Company's House, and that will say that there are 20 Class A shares owned by Keith's holding company, for example, 30 Class B shares held by my holding company, and 40 Class C shares held by some other company. And when we're actually issuing the shares, then that will also be there'll be the board resolution registered at Company's House. And then sometimes we might need to do something on the Articles of Association, in which case also we've got the shareholders resolution and registering that at Company's House. Because incidentally, um, we're going to see one example in a moment. We're finalizing a joint venture, and the lender noticed that the standard articles of association could potentially present a problem because the standard articles of association say decisions must be made by two or more directors, but it doesn't state what happens if there's only one director. And the lender picked up on that and gave us an example of case law and said, we'll lend, but change your articles first. So what we did is I did a shareholders resolution because everyone was agreed. We didn't have to respect the 14-day notice. And we did a unanimous shareholders, well, we're in the process of signing it all, shareholders resolution. And then those updated articles will be published on Companies House.
Okay.
So, but at the end of the day, Keith, and this is like a comment to everyone, we're doing everything properly, but in practice, most of the shareholders don't necessarily have enough experience to understand this, are not always taking in, obviously, legal advice on every single thing. So at the end of the day, it still is a question of trust between we're doing everything to protect everyone, but is also a question of being comfortable working with other people.
Agree.
Yeah. I'm going to go on to the remaining slides because, in fact, I need to finish today at just after 8 o'clock. I'm off up to Liverpool this evening, in fact, looking at some properties up there tomorrow. So let's go on. We've got some examples. So this is the example of the one that I just mentioned, where we have to change the articles of association. Here we're looking to complete on this purchase. We were looking at the end of this week, but things always get delayed a bit, so it's probably going to be next week. So this building here, it also goes back to the left. So it's quite a big-ish building, and it's got a lower ground floor as well. It's currently offices, primarily offices. We're going to be converting this into 3 separate dwellings, so 2 flats and a house. And we're going to be refinancing and keeping this to operate as serviced accommodation. So on this one, the way that it works, we've got a 450K purchase, 165K conversion costs. We've got 3 joint venture partners coming into the deal, bringing 220,000, which is the money that we need for the deposit, legals, and getting started. The bridging finance is covering the remainder of the purchase and all of the conversion costs. And when we've finished, we're expecting to get a GDV of around 850, refinance at 70% loan to value, pay back 50% to the joint venture partners, so they'll be leaving some money in, and then everyone gets a share of the ongoing income and capital appreciation. But on something like this, probably, to be honest, on my side, there's probably something like 2 weeks of paperwork, getting everything set up and above board and up and running, plus obviously the negotiations of the purchase and everything else. So this is one example of a joint venture. This is another example of one. We like to do joint ventures also, where we can combine joint venture and creative deal. So where we can agree something with the vendor, so we don't have to pay all the money up front. So in this example here, this, by the way, is a deal that didn't go through for various reasons, but this is an example of how we structured it and how it could have worked. So we got a value of this on this hotel of 1.1 million. We'd agreed to pay up front 400K to the owner and give him the remaining part of the income over 5 years from the ongoing profit. And the JV partners who put the 400K in would end up after 5 years with 50% ownership of a property, probably after 5 years worth something like 1.4 million. So not exactly double, but close to double the equity, which is the sort of thing that we can do with creative deals. And then another one that I mentioned briefly, this is one uh, which we're currently still awaiting the planning result. And this is one also, this is a JV, a creative one, because the joint venture is set up and we have the owner of the property in the joint venture. So basically, the owner's transferring the ownership of the property into the joint venture company. But in this case, the owner isn't remaining for the ongoing share of income. When we finish and refinance, the owner gets the payment for the property plus the share of the uplift. Sometimes we go into a joint venture where the owner's putting the property into the project and wants to keep part ownership and have the ongoing income. So we've got the different ways of doing things. So to summarize, benefits versus risks. Benefits, we can generate higher returns. We're sharing responsibilities and we can get into bigger projects. Risk, obviously, shared ownership. We need to be comfortable working with other people, and we need to have everything clearly agreed and understand, yeah, what happens in the case of different problems that can occur. And we're also, if we're looking at a joint venture, we need to be sure that the principal partner has got the experience and the knowledge to be able to, and let's say the temperament as well, to be able to deal with the project. I'll put a comparison here between two other property strategies. So portfolio building is a standard buying houses, renovating, refinancing, and growing bit by bit portfolio. Joint ventures is what we've been speaking about now, and fractional ownership. That's something that one of the things that that I do, which is offering shares from £100 upwards in individual properties. So if we look at the spread, the type of returns, the fractional ownership, the returns are smaller because typically they're guaranteed returns. When people are building their own portfolios, this can be quite high if there's really active buy, renovate, refinance, and getting most of the money out. Otherwise, we're talking about this sort of range, 6 to 15%. And the joint ventures, typically on the money that's left in, we are able to get higher percentages. And when I put here hands-on involvement, yes or no, it doesn't mean to say that I'm undecided and I don't know whether it's yes or no. We can do portfolio building by being actively involved ourselves, finding properties, managing the renovations, and then we can expect to get close to all money out. Or we can pay a sourcer to do it. We can pay someone to look after the project management. Obviously, then we're not going to get all our money out, but we can still rapidly grow our portfolio. And the same on joint ventures. We can be on either side of the coin. Either we can be bringing the expertise and the knowledge and the time. So obviously hands-on involvement, or we can be on the investor side. So yeah, key takeaways. Obviously doing things with other people is giving access to experience, and generally 1+1 or 1+1+1 makes more than three in the case of property investments and property projects, because we're like leveraging other people's skills, and typically also we're still leveraging the bank finance. So obviously we do have joint ventures. Maybe people in the group also have joint ventures. And yeah, we've got probably 2 or 3 minutes left if there are any questions or comments, something that someone would like to add to the discussion.
Trevor, we might run out of time on this, but would you be
Probably.
happy to would you be happy to share separately, I don't know, over email or whatever, like different examples of the JV structures. I mean, I think what I'm particularly interested in, you're probably aware of what I'm negotiating at the moment, is things that involve a joint venture with the property owner.
Yes, yes,
Um, I think there's some nice creative ways of doing things. So I think you've got a few examples of those, and it'd be really helpful to share examples of the joint ventures.
yes,
Um,
yeah.
just that split.
In practice,
And
joint ventures with the owners are really great deals, but they're generally the most difficult ones to get over the line
yeah,
because the owner needs to be comfortable about doing it. And the owner's natural first thoughts is, am I going to lose my property? What's going to happen, etc. And there really needs to be that level of trust.
yeah,
Or and also typically we'll work with the owner's solicitors and we'll say to the owner, look, it's not the first time we've done that. It's all like legally set up. And of course have take advice from the solicitor that you know to yeah to understand what the risks are.
just on that, because not everyone's solicitor understands what you're proposing, right?
That's
So
correct.
is it is it an option in those cases to offer a list of solicitors that you'd be saying they can represent you, but these people have the expertise? And in that situation, maybe digressing a bit here, you end up paying the legal costs for the vendor.
Yeah, we never pay the legal costs for the vendor because that's a
Hmm.
conflict of interest, and that is
Okay.
actually it's not
Yeah.
exactly illegal, but it's bad practice. And if
Yeah.
something were to go wrong and it were to find that we'd paid the legal costs of the
Yeah. Okay.
then yeah, we would always avoid. So we're saying up front, because generally what happens when we do a joint venture is the joint venture company is supporting the legal costs of setting up the joint venture based basically the shareholders agreement, and everybody is in on the discussions with the solicitor that is doing that. However, we're also stating that people can or are recommended to get independent advice, and the cost of independent advice is taken by the shareholders. And sometimes it's also a question of the people involved. Sometimes on some of the, let's say, the smaller projects, I will say to the shareholders, look, we need to do this board resolution and this and this. Are you happy with me just doing it and without us paying a solicitor to draw it up? And if people say, yeah, that's fine, we'll go for it, then we'll go for it. It's also a question of similar appetite for risk amongst the different people in the venture that you're doing. Yeah. Does anyone apart from Vatsal have a question? Then we're going to close. Yeah, because definitely Vatsal, we can share some of these structures separately. Actually, what I should say is anyone apart from Vatsal and Keith with a question. But it's really good that you're both actually contributing on this.
You kind of covered everything, Trevor.
Yeah. Okay.
Very informative.
Good. Okay. Well, I'm going to close the recording and close the session. You'll all be able to see it afterwards. And yeah, thanks for your time and hope it was useful.
Have a safe trip, Trevor.
Yeah. Okay. Thank
Thanks,
Uh,
you.
Trevor.
take care.
Cheers.
Thanks,
Cheers.
Bye.
Trevor.
Bye. See you
Cheers.
guys.
Bye bye.